The subject we are going to start it today, that is corporate accounting. Meaning of corporate accounting. Corporate accounting revolves around maintaining an organization's financial records in order to ensure that our directed rules are complied effectively and the working procedures are held within the limits of organization rules, regulation, and policies. See, we have already gone through with the financial accounting, and there are certain rules which have present in it. We have to follow the particular rules. There are certain principles, there are certain standards, conventions, concept we have to follow it. Similarly, like we talk about financial accounting, corporate accounting also have some certain rules and specification which one company has to follow because the word is corporate accounting. That means it has to be followed by the companies. Corporate means companies. So corporate accounting not only benefits the company but also enables the executives in making financial decisions. If one has to take some financial decision, very important financial decision regarding any concept of the company, so one has to adopt for the corporate accounting very well. The corporate accountants dealing with all this work are also referred to as management accountants. The work which has been dealt by the corporate accountant definitely work as a base for the management accountant because the P&L has been left out by corporate accounting. The profit statement has been made by the corporate accountant have somehow made the decision process for the management accountants. So I have already told you that corporate means companies. Let's specify what is company. A joint stock company is a voluntary association formed for the purpose of carrying on some business. When you have a company that you have formed for the basis of to carry some certain business so that you want to earn something, you have some specific object for to carry a business. That means you want to go for a joint stock company. Legally, a company is an artificial person having a distinctive name and a common seat. It is an artificial person. Company itself is an artificial person, and it has its own name. So Tata has its own name. Birla has its own name and a common seat. A company is a natural legal entity formed by the association and the group of people to work together towards achieving a common objective. So company which has formed by some people must have some legal entity to it. It will be lawful creation so that there will be no further problems related with the company. So it can be commercial or an industrial enterprise. Different types of company are taxed differently. We have different types of company, and again, it has been taxed also differently. It's done. It's actually included in the type of taxation of companies and define its types. Let's see definition of the company. According to the definition of a company by Indian Act 2013, it is the Indian Company Act who have actually wholly slowly see the accounts of corporate accounting. So as per their definition, a registered association which is an artificial legal person having an independent legal entity with the perpetual succession, a common seal for a signature, and a common capital comprise of transferable shares and carrying limited liability class. So it means a company should be registered associated with an artificial legal person. There must be a name with this company which has its own identity. It should be lawful made up. It have some perpetual succession with it. It has must have common seal that can be used for all the signatures, and a common capital that can be comprised of transferable shares and carrying the limited liability. A company always have a limited liability. Earlier you must have a partnership. Partnership we have unlimited liability. But in a company, we always have a limited liability and it has a shares which can be transferred from one person to another person. And according to British definition, a company is a body corporate or an incorporated business organization registered under the Companies Act. It can be limited or unlimited. So again, as per British definition also, company is a body corporate or incorporated business company. That means you actually made a business, you actually registered a company under the Company Act so that you can pursue with your further objective. It can be limited company or it can be unlimited company, it can be private company, it can be public company, company limited by guarantee, company having a share capital or a commodity interest capital. It can be any sort of company, but it should be registered with Indian Companies Act. The first one is features of company. Now we have already discussed what is voluntary association. Let's go in some detail. What is voluntary association? A company is a voluntary association of two or more persons. A single person cannot constitute a company. That means I cannot make a company. I must have two or more person to collaborate so that we can actually make a company. The minimum number of company to form in a private company, if I want to make a private company, the minimum number I must have two, and for a public company, the minimum number of person that I require are seven. So that means company must have association between two or more persons. The next is independent legal entity. A company has separate legal entity, distinct and separate from its member. Company is always different from the members as well as its legal existence. Like in partnership, which doesn't have independent status, but in company we have independent status. It can sue in a court of law. It can own a property. A shareholder being an entity distinct from the company can sue the company and can be sued by it. No member can either individually or jointly claim any ownership rights in the asset of a company during its existence on its winding up. So company have its own legal entity. They are very independent from their members. Perpetual existence. Company being an artificial person cannot be do their work, so it must have some perpetual existence. There must be a death, insolvency, retirement of the members leave the company unaffected. That means whether member come or go, it doesn't affect your company. Members may come and go, but the company can go forever. That means company is only and only terminated by law. It must have its perpetual existence. It must be go whether the member exists or not. The next one is registration incorporation. A company cannot come into existence unless it is registered under the Indian Company Act 113 or any previous act. So company must be registered under Companies Act. It is an artificial person and must have a common seat. A company is a person and doesn't possess the body of a natural being, so it exists only in the contemplation of law. It does not have mind of limbs of human beings. It has to act through human beings only, like directors, members, employees. So a company have to form a common seal for its own identity. The next is limited liability. The liability of the members of the company is generally limited to the extent of the unpaid value of the shares held by a company. Unlike partnership, a company has a limited liability. In case of company limited by guarantee, the ability of each partner will be determined guarantee amount. He shall be liable to contribute the amount that is granted by him only, but the person must have limited liability. Next is transferability of share. The capital of company is divided into parts called shares. The capital is basically divided into certain parts, certain units that we known as shares, and these shares can be freely transferable. It has subject to certain conditions, and no shareholder is permanently or necessarily wedded to the company. Number of members. In case of public limited company, the minimum number is seven, and there is no maximum limit of for that purpose, that is unlimited. And in case of private company, the minimum members are two, and the maximum are 50. Next is management. The shareholders are the real owner of the company. That, but being in a large numbers, they cannot take part in day-to-day activity of the business. So the company is managed by board of directors elected by the shareholders. Shareholders choose some members so that they can be acted as board of directors, and the major certain decisions can be made by them on behalf of shareholders. It may sue or may be sued because company is a legal person. It can enter into contract, can enforce the contractual rights among against others. So it can sue and can be sued in the name of if there is any breach of contract by the company. Next, we have classification of joint stock companies. We have three main classification. The first one is on the basis of incorporation. The second one is on the basis of liability, and the last one is on the basis of public interest. So let's go with the first classification on the basis of incorporation. Again, these are further classified into three categories. The first one is started company, the second is statutory company, and third is registered company. Let's see first one, chartered company. If a company is incorporated under a special charter granted by monarch, it is called chartered company. For example, East India Company, Bank of England, all these are example of chartered company. The next one is statutory company. A company which is created by a special act of the legislation is called statutory company and is governed by the provision of such any act like RBI, State Bank of India, Reserve Bank of India, Unit Trust of India, Life Corporation of India, all these are example of statutory company. Registered company, a company brought into existence by registration with the registrar of company. If you actually registered your company under any Indian Company Act or earlier or the previous act, that means you have a registered company. The next one is on the basis of liabilities. On the basis of liabilities, again we have three classifications. The first one is companies with unlimited liability. The second one is company limited by share. The third one is company limited by guarantee. So the company with unlimited liability, a company laying no limit on the liability of the members is known as unlimited liabilities. The second one is company limited by shares, a company limiting the liability of its member in the amount unpaid on shares respectively by them. So they have some limitation regarding shares, and the company limited by guarantee. In case of these company, each members give guarantee for the debt of company to pay to a certain extent and is liable to contribute the asset of the company in the event of its winding up. So a person must have already made this plea that they will pay some certain amount when the company will be wind up. The next classification is on the basis of public interest. The first is private company. Section 2, subsection 68, work for the company at 2013. Private company always registered under section 2, subsection 68. Public company have section of 2 as well as subsection of 71. If a company is registered under section 2, subsection 71, that means it is a public company, have a minimum share capital of 5 lakh rupee, higher paid up capital as prescribed. And if a company is registered under section 2, subsection 68, that means the company has minimum 2 members, maximum 50, and they don't have any right issue of right shares. Next is small company, whose the company came under small company who has a section of 85 under section 2, whose paid up capital does not exceed 50 lakh rupees or such higher amount shall not be more than 5 crore rupees, and the turnover of these companies should not exceed 2 crore rupees are called small company. The next is one-person company. One-person company is new concept in India under the Company Act 2013, Section 2, Section 62. One-person company means a company which has only one person as a member. One-person companies are required to identified in name in bracket as one person company after its name. Section 3, subsection 1, clause 3 of the Company Act provide that where the company to be formed to be one person company is a private company, The company may be formed by one person subscribing its name to memorandum and company with the requirement of the Act in respect of registration. The next is government company. When a company registered under section 2, section 45, it is a government company. Government company is a company in which not less than 51% of share capital is held by the central government or any state government, or partly by central government or partly by one or more state government. And it includes a company which is subsidiary of a government company. So government company must have 51% share. Holding company and subsidiary company. A company is known as holding company of another company if it has control over the other company. On the other hand, a company deemed to be subsidiary company of another company if it at least fulfill the condition. The first condition is the major company must have composition of board of directors. The other company holds more than half in the nominal value of its equity share capital, and the subsidiary of the other company, which in turn is subsidiary of other company. So the one must be parent company and the other will be subsidiary company. Deemed public company, section 43, subsection clause A provides for the private companies employing public capital to be treated as a public company. The object seems to be prevent big companies to which the public have subscribed from forming themselves into private company in order to put some restrictions placed on public company. The last one is foreign company. If a foreign company is one which is incorporated in a country outside India under the law of that country but has a business in India, is called foreign company. First, see the private company versus public company. It is very important. Private company must have minimum member of 2 and the maximum member of 200. Public company must have minimum 7 members and there is no limit on maximum number. A private company at least have 2 directors and public company at least have 3 directors. If we talk about private company, there is no consent is required or any restriction on appointment of directors. And if you talk about public company, you must have gone with the consent of registrar to appoint the director. The next is transfer of shares. For private company, article of association is required to impose restrictions on transfer of shares, but in public company transfer of shares are very freely available. Next is private company cannot invite public, and public company can issue prospectus to invite public for their to purchase their shares. Private company immediately after incorporation can commences business, but for the public company they have to actually wait for the certificate of the commencement of business from the registrar itself. Quorum is basically where the main member have to take some decisions. So for quorum in private company there must be 2 members, and for public company there must be 5 members. There should be no obligatory regarding statutory meeting in private company, but for public company they must conduct a statutory meeting because they have to submit their statutory report to the registrar on the time basis. Formation of a company. Formation of company generally involves 3 steps. Number first is promotion, second is incorporation, and the third one is commencement. The first is promotion. A company may be formed for carrying on a new business or for absorbing an existing business concern or for amalgamating two or business concern. It can be possible a company must carry a new business, or it can be a result of any amalgamation of 2 companies. So a person who conceived the idea of setting up a new venture is called promoter. So the one who actually thought about the company, he actually is actually a promoter and will promote the company. The next one is incorporation. The company law requires the promoters of the company to prepare and present some documents. These documents are memorandum of association, article of association, submission of proposed agreements, a statement of the nominal capital, notice on the address of registered office, list of directors, written consent by proposed director, and a statutory declaration. Memorandum of association is basically very important, and it is a document in which company, the clauses of company, its name, registered office, objects, liabilities, and capital, all of these things must be mentioned. At least 7%, each pertaining to take at least one share, must describe their names in memorandum that must be duly signed, stamped, and witnessed. Whereas article of associations are the rules, regulation, and bylaws for the internal management of affairs of the company. These these laws are framed with the object of carrying out the aims and objects as set in the memorandum. In case of public company, they doesn't require any article of association. So these are the documents which are must be there by the company at by the time of incorporation. The next is shares. The total capital of the company is divided into units of small denomination, and one of the unit into which the capital of company is divided is called unit. Total capital, the entire capital will be divided into small units, and one unit is called share. A share indicates the unit of ownership of a particular company. For example, if a company has a share capital of 60,000, which is divided into 6 lakh, which is divided into 60,000 units, that is of rupees 10 each. It means 60,000 are the shares of the company. If an I being the owner of one unit of that capital, that means I have ownership of that particular company by one share. If you are a shareholder of a company, it implies that you as an investor hold a certain percentage of ownership of the issuing capital. As a shareholder, you stand to benefit in the event of company's profit, also bear the disadvantage of the company losses. So if as a shareholder, there are certain advantages as well as certain disadvantages. If the company is growing, they will actually provide you a good amount of dividend. And if a company is facing some huge losses, you have to bear the consequences also. Types of shares. The first one is preference share. The second is equity share. So what is preference share? Preference shares, also commonly known as preferred stock, is a special type of share where dividends are paid to shareholders priority to the issuance of common stock dividend. Actually, preference shares are those shareholders which have some preferential rights over the common shareholders. Common shareholders are the equity shareholder of the company. So whenever they have preference above in any right or in any profit, that means they have some preference and they are called preference share. Consequently, if the company lands into bankruptcy, preference shareholders are the issued dividend first or have the first right to company asset before the common stock investors. For preference holders, the dividend is fixed. However, they do not hold any voting rights as opposed to common shareholders. Equity shareholders have the voting right, but preference shareholders doesn't have any voting rights. Investors who have been in the stock market for longer than must go after preference share type. The investor who want to actually go for the long run associated with the stock market, that means they must purchase preference share types. The dividend earned on these shares are significantly higher than the ordinary shares. Their popularity can be established by the fact that many preference shareholders do not own any other stock except for the variety. Features of shareholder. The first feature is preference shareholder have significantly more heft than standard shareholder of any company. They have the first rights to all the dividends paid by the company whose shares they own. Holder of these shares do not have any voting right in any business proceedings. The features thus also falls among the major disadvantage of preference shares. It might seem like a major handicap for an investor. However, it is precisely the reason why so many companies offer these shares. The aspect is also similar to debentures owner. One feature which is under advertised is that dividends are paid to shareholders on the specific date. It is not entirely similar to monthly income. If an investor decides to buy special types of these shares, they should look for irredeemable preference share. These shares allow the holder to have a certain say on their maturity dates. One of the advantage of preference share is that they are identical to PAT, profit after tax for most corporations. The taxation element is decided on the dividend that are payable on every pre-arranged dividend fund. Classes of preference shares. We have four classification. The first one is from the point of view of redemption, from the point of view of dividend, from the point of view of participating in profit, from the viewpoint of convertibility. So the first one is redeemable preference share. In this case, in the case of redeemable shares, a company has the right to buy back the share for its own use from the shareholders at a fixed date or given prior notice after a period of time. After a certain time, you can actually redeem your preference share, that is called as redeemable preference shares. Irredeemable preference shares, these shares can only be redeemed by the company at any time of liquidation or when the company winds up operation. Irrespective of redeemable preference share, irredeemable preference share are those shares which can only be available to the shareholders when the company is going to liquidate. Cumulative preference shares are shares in which if a dividend goes on cumulative till not received. For example, if a company has not paid the dividend to their preference shareholders, specifically cumulative in 1 year, so in the second year they will have to pay first plus second year of the dividend. Non-cumulative preference shares are those who doesn't receive any share of any year of dividend. For example, if a company does not pay any dividend in the first year, but they are able to pay the dividend second year, so they are only entitled to pay the first year dividend. Participating preference shares. Participating preference share is where the company issuing the dividend pays increased dividend to the shareholder along with the preference dividend. This is done at a fixed rate. Participating preference share are those preference shares in which you have a fixed rate. They have right to surplus asset of the company at the time of liquidity. Non-participating preference share are those shareholders that are entitled only to a dividend at a fixed rate, but not to the surplus profit. The extra profit is distributed among the common shareholders. Next is convertible preference share. Shareholders of such shares have the option to convert the common shares to preferred share. These shares are opted by investors who wish to receive preferred share dividend as well as want to benefit from an increase in common share. So they have the benefits of twofold, that is fixed return plus they have the opportunity of higher return. Non-convertible preference shares are those preference shares that doesn't hold any right to convert to the issuer's common shares. Next we have equity share. Equity shares are those share capital, they have residue in nature. They can also known as common common shareholder of the company. Equity share capital remains with the company. It is given back only when the company is closed. They are permanent in nature. Equity shareholders possess voting rights and select the company's management. They are actual owner of the company and bear the highest risk. Equity shares are transferable, that is, ownership of these equity shares can be transferred with or without consideration to other person. Dividend payable to equity shareholders is an appropriation of profit. Equity shareholders do not get fixed any rate of dividend. Equity shareholders have the right to control the affairs of the company. The liability of equity shareholders is limited to the extent of their investment. Let's see the difference between these two now. Equity shareholders are the ordinary share of the company. It represents the part ownership of the shareholder in the company, while preference shares are the shares that carry preferential rights over the payment of dividend and repayment of the capital. Repayment of dividend. Equity shareholders are receive dividends Only after settlement of all the liabilities, the shareholders may not get any dividend at the time of loss. Also, they have no right to get any area of dividend. While the preference shareholders are paid dividend in preference over equity shareholders, cumulative preference shareholders have the right to get areas of dividend also. Rate of dividend. The rate of dividend is not fixed, hence it is fluctuating after year after year, while the rate of dividend remains fixed every year for the preferred shareholders. Voting rights. Equity shareholders enjoy voting rights in the general meeting, while preferred shareholders do not have any voting rights in the general meeting. Convertibility. Equity share cannot be converted while preferred shares can be converted into equity shares. A repayment of capital in the event of winding up of the company, the equity shareholders are repaid at the last only after settling the other liabilities. And the event of winding up the company, preference shares are always repaid before the payment of equity shares. Redeemability. Equity shares who are not redeemable while the preference shares are redeemable. This is all about today. What is shares? What are the types of shares? Equity shares, preference shares,